Have you ever wondered what banks do with your money when it just sits in your account? Spoiler alert, it doesn't just sit there gathering dust. Banks are using it to make massive profits while paying you close to nothing. Today, we're diving deep into the secret world of banking. I'll show you exactly what banks do with your money and, more importantly, how you can invest like them to maximize your returns. Stick around because this knowledge could change the way you think about money forever. What banks do with your money? Let's start with the basics. When you deposit your money into a bank, whether it's in a savings account, checking account, or even a CD, you're essentially lending your money to the bank. Most people think their money is just sitting there waiting for them, but that's not the case. Banks use your deposits as a foundation for their business. Here's how it works. Banks lend out the majority of the money you deposit. For example, they might offer personal loans, mortgages, or business loans to other customers. They charge those customers interest rates ranging from 5% to 15%, depending on the type of loan. Meanwhile, they pay you almost nothing in interest on your savings account, usually less than 1%. That difference, called the interest rate spread, is how banks make a significant portion of their profits. Banks also invest your money in relatively safe financial instruments like government bonds, corporate bonds, and even blue-chip stocks. These investments provide steady returns for the bank while still allowing them to meet withdrawal demands. Fractional reserve system. This is the key to how banks operate. They only keep a fraction of your deposit as reserves, usually about 10% or less. The rest is lent out or invested. For example, if you deposit $1,000, the bank might keep $100 in reserves and use the other $900 to make loans or investments. By leveraging deposits like this, banks are able to generate huge returns while giving you a small fraction in return. Why you should invest like banks? Now that you know how banks use your money, let's talk about why you should invest like them. Banks have a tried and true strategy for growing wealth: safe, diversified investments and the power of compounding returns. Banks don't rely on a single asset to grow their money. They spread it across multiple investments, including bonds, stocks, and loans. You can do the same by building a diversified portfolio. For example, you could invest in ETFs like SCHG or SCHD, which give you exposure to a wide range of companies, reducing your risk. The power of compounding is one of the reasons banks grow wealth so effectively. Let's take an example. 2. Compound growth. Imagine you keep $10,000 in a savings account earning 0.5% annual interest. In 10 years, that money grows to just $10,511. Now, invest the same $10,000 in an index fund earning an average of 10% annually. In 10 years, it grows to $25,937. See the difference? Banks know this, and that's why they put money to work in high-yielding assets. Inflation erodes the value of money over time. By investing in assets that grow faster than inflation, like stocks and real estate, you can protect your wealth. Banks do this by holding inflation-resistant assets, and you can too. How you can start investing like a bank. So, how can you start investing like a bank? Here's a simple 4-step plan. Start by investing in a mix of stocks, bonds, and ETFs. For beginners, ETFs like SCHD, which focuses on dividend-paying stocks, or VTI, which tracks the entire U.S. stock market, are great options. These funds give you broad exposure and reduce your reliance on any single investment. Banks don't chase quick wins, and neither should you. The magic of compounding happens over years, not days. Focus on holding quality investments for the long term. Invest in dividend-paying stocks and ETFs to create a steady income stream. For example, Realty Income O is known as the monthly dividend company because it pays dividends every month. Banks use leverage to amplify returns, but they do it cautiously. As an individual investor, you can use margin accounts or other tools, but only if you fully understand the risks. Start small and grow sustainably. My portfolio and how I diversify. I want to take a moment to share my own investing journey. I've built a diversified portfolio that includes growth stocks, value stocks, dividend-paying stocks, and ETFs to maximize returns while managing risk. My portfolio recently hit $201,000, and I share updates regularly here on this channel. I focus on long-term growth and passive income strategies. This account is dedicated solely to long-term investments, and I'm constantly looking for ways to improve my diversification. If you're interested in seeing exactly how I structure my investments, check out my other videos for full portfolio updates. And there you have it, the secrets of how banks use your money to build wealth and how you can apply the same strategies to your own investments. The key is to think like a bank, diversify, invest for the long term, and let compounding do its magic. If you found this video helpful, please give it a thumbs up and subscribe to my channel for more tips on investing, personal finance, and building wealth. Follow me for updates on my portfolio and how I diversify my investments. Don't forget to leave a comment below on what's your favorite way to invest. Thanks for watching, and I'll see you in the next video.